Welcome to The Owner's Exit, the podcast where business owners learn to plan smarter, exit stronger, and move forward with confidence. In each episode, you'll hear from industry experts, seasoned entrepreneurs, and owners who've successfully navigated their exit. Together, we'll unpack the real stories and proven strategies beyond smooth, successful transitions, and share practical advice for your own exit planning journey. So if you're a founder, entrepreneur, or business owner thinking about what's next, you're in the right place. This is the Owner's Exit Podcast, where we help owners see to, through, and beyond the sale of their business. Real excited about this one. Conor Lange. Conor Lange. He's vice president of River Associates, which is a private equity firm based out of Chattanooga, Tennessee. River Associates focuses on lower middle market companies across a variety of industries. Conor plays a role in sourcing, evaluating, and managing acquisitions. He brings expertise in deal structuring, founder transition, and operational scaling. He's known for helping founder-led businesses professionalize and grow post-acquisition, and passionate about creating win-win outcomes for founders, leadership teams, and investors. So, Conor,
well
thank you.
Thank you
thanks
guys.
so much.
I'm fired up to be here.
We're really excited. So cool. First, the question I want to talk about, or the topic that I want to talk, so private equity strategy and fit. So what sets you guys, River Associates, what sets you apart from the typical PE space? How are you different?
Yeah, I mean, obviously there's lots of private equity firms out there. The industry's gotten more and more mature, so there's lots of competition out there for us. And I think we've been really fortunate. We've been around a long time, so I think our legacy, our heritage, our experience is one thing that sets us apart. We've been around for 35 plus years. Our track record. Mm-hmm. And even probably more so, there are plenty of funds that have been out there for 35 plus years, but our fund has been specifically focused on kind of the same type of companies, lower middle market, founder-owned businesses for that entire period of time.
When you say lower middle market, like what does that mean?
Lower middle market,
guys?
Yeah, we define lower middle market as 3 to 10 of EBITDA, so earnings basically, and call it 20 to 100 of revenue.
So it's kind of free cash flow.
Free cash flow. It's a proxy for free cash flow, essentially. Yeah. So 20 to 100 of revenue and 3 to 10 of EBITDA free cash flow.
And when you say founder-led, is that founder like one person? Can it be a founding team?
Yeah.
Okay.
Could be all of it. I mean, we say, we focus on founder-owned companies or family-owned companies. So just, not an institutional owner, really. Okay. Owned, by a founder, a family, an operator.
Someone who
could
started
be a group.
that's still involved.
Could be, the actual founder. Oftentimes it's, a second or third generation, founder basically, bought the business from their father, mother. But then sometimes it's also just, somebody who acquired the business from the actual founder and has grown it, unrelated with family. Yeah. And so I guess we would still call them like a founder, but, technically
you're not buying it from another private equity firm usually.
Usually. I mean, we have. So about 75% of our historical investments are founder-owned companies. Sure. So 25 are not founder-owned. And so we have bought businesses from private equity firms before, but we say, we're either investing in a founder-owned business or a company that has a founder-led culture. Mm-hmm. So still, I think about some of the deals that we've done, where we bought from a private equity firm where maybe we're the second institutional owner. It's oftentimes, the founder's still involved in the business. Still maybe it's ready for him to now, him or her to transition out of the business. And, that's obviously something that we do a lot and we're comfortable with and feel like we can do a good job for. But yeah, it's either when we do buy from another PE firm, it's usually we still feel like it has that founder-led culture.
Yeah. Do you guys focus on a particular industry or sector of the market when you're identifying companies to purchase?
Yeah, we mostly focus on industrial companies. So manufacturing, distribution, business services are the vast majority of what we've done and what we do. We don't do a lot of healthcare. We don't do a lot of tech. We don't do oil and gas related companies. So, mostly industrial companies. That's where we feel like we understand and bring the most expertise to.
Yeah. Steve and I, we love the word focus. Actually, our word of the year for our company is focus. And so you guys staying in your sandbox, knowing how that operates, not trying to be everything to everybody, I think makes sense. Yeah. I know you kind of purchase two different kinds of companies. One is like a platform, and then one would be an add-on. So one, a big company that you're starting anew with. Another, an add-on would be to add on in addition to this. Talk a little bit about those differences.
Yeah.
Why you focus on those two opportunities when they pop up.
Yeah, it's a really good topic. So, a platform company, that's, like you described, I mean, we're investing it to be the platform. We are, that would be the company that's on our website, the platform business that we're investing in. Oftentimes, what we're looking for is a business that's a market leading business, that has good margins, a good growth profile. We think tailwinds in the market to support the growth. And ultimately we want the platform to be something that has scale, that has, really good systems, a really good team. Oftentimes we're investing in a company that's not quite platform ready. We say we see the potential for it to be a platform, a true platform one day. We're investing in it as a platform, but we think there's still platform building to do. But so our strategy with a platform is, to buy the platform, to build out the team, the systems, and professionalize the platform. And then usually it is to go out and, do a few acquisitions with that platform that, once we built out the team and the systems, that we do feel like we can go bolt on a company or two that might bring us into a new market that we don't have a product in, or a new geography that we don't have a big presence in. And so, there are different sort of dynamics that occur with a platform versus an add-on. I mean, typically a platform for us is a little bit of it's a bigger company. It's a more substantial company. It's got more scale. Oftentimes it has it has a team that's committed to stay on with the business. It's hard to invest in a platform and the whole team run away, and then you got to go hire a whole team. Whereas, sometimes it's a little easier to do that with an add-on because you already have a management team. And so if you've got, a business where the founder or the primary management team is sort of looking to transition out and there's not a whole lot there otherwise, sometimes that's a better opportunity for that company to be bought as an add-on.
Yeah. So your platform would kind of be your quarterback, your Patrick Mahomes, and then you're adding on a good Travis Kelce, left tackle. Are you able to share about a specific circumstance that you all made a investment into a platform company and then found an add-on that worked well?
Yeah. A few examples come to mind. I'll start with one. It's a business based in kind of the Oklahoma, Texas area. We bought the business from two brothers who were second generation owners. Their dad started the business. It's a business that's in the traffic industry. So they make the core business that we bought manufactures traffic hardware products. So anything from a back plate to a pole to a base to, the back plate behind a traffic signal to brackets that hold, security cameras or even the traffic light on. So very hardware focused. It was a dominant player in that market, kind of a legacy brand in the space with a really good product and a really good, name in the industry, great relationships with its distributors around the country that sold the product. And it was a sizable business, really nice, facility, big, facility, had a good team. It needed to be built out more. And so what we did is, those two brothers were actually sort of more in the phase of, looking to slow down, looking to transition out of the business. And so we elevated the VP of sales to become the president and eventually the CEO of the company. And we went out and built out the team further. We hired a CFO. We hired a chief information officer. We hired a chief operations officer to help, build capacity in the plan and get us to be more efficient. So, and we also did an ERP system implementation. So that was a big project.
ERP is?
It's basically
like a CRM?
A CRM is a customer relationship management service. This is ERP system. I'm forgetting what the synonym is or the acronym is, but it's, where.
What does it do?
It's where the accounting runs through. It's where the operations run through.
Hub,
it really is the backbone. It's this, spinal cord of the business where everything kind of operates out of. And an enterprise resource platform or something like that, I think. But really, it's where operations runs really through. Yeah. It's where accounting runs through. It, you can bolt a CRM on top of it.
Sure.
It's really important to have, ultimately to have everything integrated on that platform because then, you can have purchasing talking to operations and they know, when you're going to
just really
be out of material and
everybody
it really
involved.
helps optimize the operation of the business. So we put in a nice ERP system there. And after that, we really felt like the platform was built out. So then we wanted to go out and do add-on acquisitions now that we had the platform built out. And so we really saw opportunity to buy a few companies that were more in the technology side of the traffic industry. So, push buttons at crosswalks and flashing radar speed signs and wrong way, detection systems when you're going the wrong way on the highway, really important for safety. Those were products that our, platform company did not really offer. And, high growth parts of the segment, really valuable given, safety trends and these products really do prevent accidents and prevent deaths. And so we were able to bolt on 3 companies, all that kind of made different technology products, all in the traffic safety space. Yeah, one was a company that makes the push buttons that integrate with the crosswalk, and one is more of
those buttons never work for me.
Well, our company does.
Come on, turn.
Do you have a little brand below so we know? Okay, no, this one's gonna work.
Yeah,
so you got to push
head safety. That's
head safety. Okay.
So yeah, long story short, we went out and did 3 of those acquisitions, all to grow us into the tech space, and our platform company that had relationships with all the distributors around the traffic industry. Now we could say, well, you can buy everything from us. You can buy the hardware products and the technology products from us. And, our customers like doing business with us, and it was, allows them to just go to one person instead of having to deal with multiple vendors. So, it's been a great story. We bought the business. It was doing about 40-ish of revenues, and it's approaching 100 now. So really nice growth story.
Now the founder, the brothers, right, that were looking to exit the initial platform business. How did you get introduced to them? How did you stumble across the company? What's that process like of sourcing deals?
So this deal, and this is how most of our platform deals are sourced, is through investment bankers. So these 2 brothers knew that they, wanted to pursue a monetization event, a sale. And so they hired a few investment bankers and hired one specifically. And they really wanted, it was actually, bought this company sort of during the heart of COVID. And so made everything a little more difficult, travel and everything. So they ran a smaller process. I mean, investment bankers generally run auction processes, send, materials out to lots of different buyers and basically run an auction process till the end to see, who is the ultimate winner. And so these 2 brothers hired an investment banker, and we have a marketing partner person at our firm. He's been at River for over 30 years, so he has incredible relationships with the deal community. He knows every sort of every banker, every broker in North America probably, and that's not really an exaggeration. And so he had a good relationship with this banker. We got the opportunity. We hopped on it right away. We saw thought it was a really good fit for us, and ultimately we're successful in buying it.
And so I know you were an investment banking analyst before you joined River. And an investment banker, their role is to work for the founder, the business owner, create pitch deck, leverage relationships, really to get the business in front of potential buyers, most of the time private equity, and really help facilitate that deal, correct?
Yeah, they're incentivized for that.
That's right.
For the sale.
That's right. So they really what they're, hopefully doing when they sit down with, the founder, the owner of the business is figuring out what they want out of the deal, right? Sometimes, valuation's always important. The ultimate purchase price is always important, but it is a different buyer universe when it's like, look, I want to be done with this. I want to sell the company for as much as I possibly can and walk away. That is an opportunity that's probably better for a strategic buyer, a company like we were talking about that already has a management team in place and can bolt it on as part of their business versus, look, I still feel like I've got 5 or 10 good years left in me. I do want to diversify my net worth a little bit, take some chips off the table, but, I feel like there's a huge opportunity for my company to continue to grow. And I want to bring on a partner to help me fund and think about and strategize that growth. Different, set of buyers and different, so it's really, I think it's really important to for bankers, and they do a great job of this, of understanding what the goal of the owner is. But yeah, so then they, depending on the goals, they make materials, they, position the company, help them figure out their earnings level, and, what the growth strategy and story is generally, and then send it out to buyers that they think would be, good buyers for the business, whether that's a PE buyer or, a strategic, a company that could add it on to their existing business. And then to your point, Steve, the bankers are getting a percentage of the ultimate deal value. That's how they're, paid. And so they are incentivized. Obviously, the more the company sells for, the more they get paid. And so, it's alignment of interest there.
Or is the payment to the investment banker generally through the private equity company or the seller?
It would be funded in the transaction. It would be paid technically by the seller.
But it would
be sort of netted from their proceeds or wired from their proceeds. But it's paid by the seller.
Now, every business seller is different. But in your experience, do most sellers kind of, whenever they get those net proceeds, kind of take 100% of their chips off the table and walk away, maybe work for a salary? Or would there be opportunity to continue in the participation of the growth of the company?
Yeah. All different kind of flavors and desires.
What do you guys prefer?
Our preference is, for the owner to retain at least some ownership in the company.
So it keeps
it's similar to the investment banker. It's the alignment of interest, right?
Yeah.
We want an owner that wants to reinvest in the business because that means he or she believes in that there's more growth opportunity out there, right?
Yeah.
So,
and they believe in what you're doing.
And they believe in the strategy and us and what we can bring to the table and help support them. And so, it's, our tagline is investments with management. So that's obviously really important to us to have, aligned interests with our management teams. We offer, incentive equity pools for our management teams too, which is essentially free equity. And, that again, they're the ones driving the growth and we want them to be, motivated and compensated for the growth that they deliver. So we definitely do have a preference towards, owners that want to retain at least some ownership in the business. It doesn't have to be, 50% ownership. It can be 5, 10, 15%. And it depends on, every owner's desires, but we do have a general preference for that. But we do deals, often where the owners maybe not rolling equity, and kind of to your initial sort of example, Austin, those tend to be more add-on scenarios than platform scenarios. Tends to be a little bit better.
Yeah, that makes sense.
So I know that you guys prefer to work with founders. And so, or if the founders are still involved. And so how do you decide if a founder should stay on as the key leader, key CEO? How do you know if that's
a tough situation, right? I mean, some situations, I think the founder, sometimes the founder's already, hired somebody to be the president. I know we bought a company recently where, the founder kind of taken a step back, had already sort of identified who she thought the successor was and had promoted that person to president. That person had been around the company for a few years. That's actually a good scenario because, it takes risk off the table a little bit for us, right? Like we've got the president, and this person's done a good job. It's stable. We don't have to go out and hire, a new person, which is always risky. I mean, we do it all the time, but so that actually is a really thoughtful, good scenario. Sometimes, like the scenario I was talking about with the two brothers, they weren't clear with us up front. Like, I do want to stay with the business. I don't want to stay with the business. And so it just took a lot of conversations and feeling each other out and, continuing to get to know each other and trust each other, and us sort of describing, here's, what we love about your business. Here's what we want to do with your business. Do you agree with this? Like, are we missing something? And here's what we think it's going to take to do this. And, you're going to have to work really hard, 60 hours a week, maybe for the first couple years. And is that what you want to do? And a lot of times it'll come out, well, maybe it's better off that, you guys hire somebody from your network to run the company. I'll stay on the board. I'll remain involved in these 1 or 2 or 3, key areas that I'm really passionate about. But, maybe it is better for us to, find a new true CEO leader for the business. So it's always a topic, and it's usually one that takes 3 or 4 rounds of conversation before you can kind of really feel out what the right move is.
Can you tell us a story about when you guys had to have a hard conversation where it might be time for a CEO to step aside?
Yeah.
Or another key leadership person.
Yeah. So one example of that, we have a business in Canada that we bought, and that's actually an example of one that we bought from another private equity firm. But I was describing, the founder was still running the company, so he was still the CEO. They had PE firm had bought it from him. He had taken some chips off the table. He had reinvested some in the company. They had gone out, built out the management team some. They'd done 1 or 2 sort of smaller add-ons, but he was still running the company. And he loves the company. It's really his life. And you can imagine that's a lot of times that's how, founders have put their whole lives in the companies.
So much identity is wrapped
so
up
much
in
of their
ownership.
identity. Yeah. And their relationships and their life and the hours they've spent working. And so, this guy, phenomenal guy, is still on our board. We've got a great relationship with him. He knew that he wasn't going to want to be the leader for probably the next 5 years. We knew that we were going to have to, transition him out. We hadn't really established a timeline. And so, it just we were invested in the company for probably a year, and they had some, earnings were declining a little bit because they had added a lot of people and cost to the business, and their margins were getting pinched. And, I think he would tell you, like, he just hadn't really managed a business with 200 employees before. And, they had just done 2 add-ons. It was just a business that had sort of outgrown his expertise and probably his energy levels. He was, getting close to his 70s. And so, we went to him and said, look, we think you're so valuable for the business. We want you to remain involved. We want you to remain on the board. But, we've talked about this. We do need to transition you at some point. We think now's the right time to go ahead and go out and find a CEO.
How did he receive that?
He actually received it well.
He did.
He did. Yeah. He was super supportive. I think it was
in his best interest financially, probably.
Yeah. And he had rolled over equity again in this deal. So he, has a reinvestment and I think, and I don't think this is the only time this has happened. I think he was relieved too. I think he, in his heart, probably knew it was time, and maybe he was waiting for us to say something earlier than we did. But I think he was very relieved, I think, and very supportive of the move. And it ended up to be a fantastic move. We hired a phenomenal CEO, and we've done 2 great add-ons since then, and really grown the company a lot.
Yeah, obviously, you guys look at a lot of businesses. A lot of stuff comes across your desk. Pitch decks that have qualitative information in it about the management team, customers, but also quantitative about earnings, revenues, EBITDA, like you spoke to earlier. Again, with this podcast being focused on the business owner wanting to maximize an exit plan, based on what you see and you find really attractive about companies, what are 1 or 2 or 3 things that you would say, hey, business owner, you need to focus on this if you're thinking about selling in 3 to 5 years?
Yeah. It's a really good question. I'll try to keep it to 3, but I may rattle off a few
we
more.
Got time. We got time.
What we look for in a business, we look for, all sort of I would call the standard fundamental, maybe basic stuff that other PE firms look for: strong margins, good growth, a good market position, a company that has a great reason to win, whether that's a better quality product, better on-time delivery, better service, et cetera. We want to understand all those things.
But that's what everybody wants.
But that's what everyone wants. And
so what about you guys?
But maybe to answer particularly your question, Austin, about like, as you're kind of honing in those last few years, getting ready for sale, I mean, I think it's important to think about things like capacity. Can you support growth for the next 5 years? Do you have a growth strategy that you want to sell to buyers? Because that's what buyers are going to be looking for, is like, you've done great, but like, you're going to get paid for that. We're going to get paid for the future, for the growth, for the opportunity.
An investment for you.
And so what is your plan? What do you see as the opportunity here? Do you have a team that can execute on that strategy? I mean, we do a lot of deals where we're helping the founder build out the team, but company's more valuable if it's got a deep team that you feel like you can go day one, hit the ground running, and go execute on the plan.
Where the owner's a little bit, we call it's reduced owner centricity, right? Where the whole business just isn't on their shoulders.
Yeah,
stakeholders, customers.
Or another way, it's like what is it? E-Myth, the first book you have to read in business school. It's like the owner's wearing so many hats. You got to take some of those off.
Totally. Yeah. I mean, that's oftentimes, one of the first things that we're helping companies do is the founder not run every department of the company, bring in a CFO, COO, but
they don't answer all the questions.
But if you can do that before the process, that's just going to impress buyers even more. And
it's going to reduce workload for you guys when you step in.
It is.
Because that system's already been taken care of. Because they're not worried about that.
Correct.
There's management in place that makes those decisions.
Yeah, and you don't have the hiring, there's always risk in hiring people. You don't have the concentration risk with the founder. And, if the founder wants to say, well, I don't know, it depends on the situation, right? But if you're a founder that doesn't want to stay around for another 5 to 10 years, it's harder when you're the whole business, right? Like, but if you've built out a team and you can, say, look, like I want to be involved at the board level, I'll facilitate a transition. I want to hear about your guys' experience in situations like this. And by the way, I've got this really deep, capable, talented team below me that does all the work anyways. That gets people really interested, even more interested.
Yeah. So for a business owner, when they do look to exit, they have a couple of different options, right? One, they could just shut the business down. Hopefully they don't do that.
Not a great option.
They could sell to, some sort of general manager or a Gen 2.
Yeah.
They could sell to a competitor. They could sell to their employees. If they say, you know what, I want to sell to private equity for whatever reason, what does that process actually look like? I know we talked about investment bankers, and their role in it all, but like, what can they kind of expect from, hey, I'm ready to start this process, to actually handing the keys over to you guys?
Yeah. So if you're engaging a banker, you're interviewing bankers, most likely, you're interviewing bankers, 2 or 3 or 4, you pick a banker, you get their thoughts on when the right time to go to market is. You prep materials. It's called a confidential information presentation or memorandum, a CIM or a SIP. That sort of what gets sent out to all the potential buyers. So you're prepping that. It's about a 40, 50-page document that they write for you. But, that outlines information on the company and the financial statements and the growth opportunities and the team. And so that takes about, call it 3, 4, 5 months of prep work, is about the fastest you can do that. And then, you send it out to buyers and, you engage. The banker really handles the engagement if you hire a banker, in terms of answering questions and basically getting inbound requests from groups. And then there'll be an IOI date. So that's sort of the first process timeline where everyone has to submit their offer by. So
an IOI is indication
of interest. Yep, okay. Exactly right. So, say you go out to 150 groups, some will pass for a bunch of different reasons, right? It's too small, it's too big, we don't invest in this industry, we're too busy, right? You just get a lot of different answers. But hopefully you're going to get, 10-ish, 20-ish IOIs. That'll be a mix of private equity firms, be a mix of strategic buyers, some sort of in the middle. And, they'll have valuation, they'll have, why they think they're a good fit for your business, what generally their strategy will be, what their timeline will be. And so, generally at that point you're evaluating, clearly valuation and price, also fit.
And that's the private equity firm that's saying, based on this SIM or SIP, we would value your company today at X.
Correct. Okay. Yep. So it's, it's based on what we know today, which is, we've got this document and we probably had one call with the banker for 30 minutes or 60 minutes. Right. So, and you're generally at that point giving a range. It's it's usually a multiple of EBITDA. So say we think your business is worth 7 to 8 times, it's trailing 12 EBITDA or it's forecasted EBITDA for the end of the year. And so that's kind of what the valuation looks like. And then, you're outlining why any industry experience, why you think you're a good fit, what your plan is. Would you want the, owner to roll over equity? Would you not? What all sort of the other kind of pieces of the deal would look like, timeline, advisors, all that sort of stuff. And so you'd go through that phase. You'd eventually pick a few groups to meet with in person at what's called a management presentation. So
is that usually, 10? Is it 5?
It's somewhere in there. It's okay. 4 to 8, I would say, is typical. 10's a lot. And especially if you don't have a deep team, doing 10 management presentations.
It's a lot of dinners.
It's a lot of steak dinners. You're going to have to start eating more fish.
And most of those aren't just one dinner.
Yeah.
It's not just one time you meet, because you'll have follow-up.
Hopefully. If the group's interested, they're going to want to have another meeting.
Yeah. And if there's 10 of those, half of them might be interested in, it's a lot of work.
And in this Zoom world, it is nice. Like now you can, oftentimes that second meeting before the next stage in the process, which is called submitting a letter of intent, sometimes you can usually do that over Zoom or Teams, like a 60-minute call. If you're really interested, we will often try to go back up and have another dinner and, another in-person touch point. Yeah. For sure. So then, you'll do those. There'll be another month or so between IOIs and then LOIs. And that's, sort of your best and final. Like We've now met the team. We've had access to what's called a virtual data room. So it's got tons of information in there, from financial information to customer, information, supplier information, employee information. I mean, it's sort of, it's a lot of data, and that's a lot of what the investment banker can help you get ready for and prep that data that all the buyers are going to want access
Conor,
to.
at what point do you guys sign an NDA with a company?
We sign an NDA at the very beginning. So before we even get the SIM, so that we'll get an opportunity from a banker, and by the way, I'm describing this as part of a banked process. We love to work directly with companies too, without a banker. We would love to do that too. But, most of the time people are hiring an advisor, and, it's generally, a smart move. But yeah, so we would sign an NDA. We'd get a 1-page, basically blind overview of the general, what the company does and sort of what it makes from a sales and EBITDA standpoint. And we say, okay, yeah, that looks like it could be a fit. We sign an NDA and then get the SIM.
When you have access to that, you call it a data room, like the owner can feel comfortable that like turning over that information is entirely secure.
Correct. Yeah, you've already met the group. You're bound obviously by confidentiality. We take that very, very seriously. It's our business, right? Sure. It's our reputation.
Sure.
There are situations though, Austin, where, say you're meeting with River, 2 other private equity firms that have, no competitive business in the space, but you're also meeting with your biggest competitor, who, could be a logical buyer for a lot of reasons, but you also don't really want them to have access to all your information. And so you'll oftentimes have some information for that group that's competitive, blinded, and you may not give them all the information up front that you would, somebody who's not competitive.
Sure.
So, you'd submit the LOI and you'd evaluate your LOIs, which group, you thought was the best fit for your business, for your priorities, and pick one. And then you'd work towards a closing, which generally takes another, call it 30 to 60 days of what's generally called confirmatory diligence. So, you can't do everything in that, couple weeks period. You try to focus on the key critical stuff, but there are confirmatory things that you got to do that, you said your customers love you. Well, let me talk to a few of your customers to make sure that's true. And, you said your suppliers, are committed to supplying you and they're not going to raise their prices 200% next month. We'd like to just talk to a few of your suppliers, things like that, confirmatory diligence items. And, then you work towards a close and wire the money on closing.
So the range of length, obviously it depends, right? Every deal is different, from when a seller meets with an investment banker, starts the process of interviewing those bankers, to close with River, is probably 6 to 12 months, right?
Yeah, 6 would be really fast. Yeah. I mean, really fast. It'd probably 9 to
if they didn't have an investment banker, maybe 6.
Maybe 6, yeah.
Right.
Yeah, if you emailed, River tomorrow, we could close your deal in faster than 6 months. But if you're hiring a banker and going to market, it's 9 to 12 months, I would say generally. Yeah, 6 months, maybe you could do that, but it'd be fast.
Okay. That's good to understand.
Yeah.
So, all right. So let's look at like post-transaction after they've sold. What is the typical hold period that you guys are seeing? And what would say an owner still has a little bit of skin in the game post-sale? What's their expectations for that next round? Yeah. And when are you guys looking to exit?
Yeah. Most private equity firms, and we're in the same sort of vein, I guess, are generally modeling and thinking about a 5-year hold period. That's pretty industry standard. So owning the company for 5 years. We at River, we're investing in lower middle market companies again that, are often founder owned, that usually do need some platform building, putting new systems in place, hiring more people. So we oftentimes are knowing that, well, this is probably going to be a little bit of a longer hold period, could be longer hold period, because we're having to put some of these,
put the system in place.
Yeah.
Adopt the system. Yeah. Use the system.
Exactly. Yeah. I mean, a year or two of platform building before we can really go execute on the investment thesis. Right. And so oftentimes we end up holding companies a little bit longer than 5 years. And we're fortunate enough, we've got an investor base that's extremely patient, and they trust us. And so, we are totally fine holding a company for 6, 7, 8 years. We've certainly had companies that we've only held for 2 or 3 years, and, just been great outcomes and grown faster than we expected, frankly. Sure. But oftentimes, especially, as we, continue to, do what we do and work with lower middle market companies. Sometimes it is 6, 7, 8 years. And we're fine with that. They're, I would say oftentimes, larger funds probably want to stick more to that, 5-year hold period. There's also, groups out there called family offices that they're structured a little bit differently than private equity firms. They're generally usually, more open to a longer hold, and that can be a positive or a negative, right? If you're an owner that is really excited about that second bite at the apple opportunity, sees a lot of opportunity and growth, maybe that's not as good of good of a buyer for you, because with us you can go out, execute on the deal, and go do a transaction in 4 or 5 years. If you're a family office might be a better fit for a younger founder maybe that is not looking to maybe grow the business as aggressively, but looking for just a longer hold and a longer term partner.
It seems as though with family offices, what we found is that they're more interested in either the cash flow or really long term growth.
Because it's fewer investors. It's usually one family or sometimes a handful of families.
So they can be patient. They either want your cash.
That's right.
And they're not looking to sell it later because they like the cash, or because that's going to fund some of their other operations, or they see this as a big opportunity later, and they can add value and they can be patient. It may be a 10, 15-year investment.
Yep. That's exactly right.
Yeah. So we kind of breezed over a River Associates fund, and how private equity kind of gets the capital that they have to go invest in these businesses.
Yep.
Talk a little bit about where that comes from and that process.
Yeah. So when we're investing our 8th fund, it's a $345 million fund. And so, as we were finishing out investing River 7, we obviously went out to fundraise a new fund, River 8. And so we go out during that process, generally go out to our existing investors. Our existing investors are generally, what we call institutional investors. So university endowments, public pension funds, insurance companies, obviously, entities with really big balance sheets that are, looking to invest that capital. And so that's what a lot of our investor base is made up of. And so, we're going out to our existing investors saying, hey, we're almost done investing in River 7. We think it's going to be a really good fund. You've, seen our prior track record. Here it is again. We'd like to go raise another fund and go kind of do the exact same thing and go invest in the same companies. And, we're going to make it a slightly larger fund, but again, we're going to be focused on the exact same companies. And so that's what the process looks like. We, prepare, an offering memorandum and legal documents that are really similar to kind of what River 7's fund documents were. And most of the time, if we've done what we said and, generated good returns with our deals, hopefully our existing investors will sign up again. And we're always looking for, new investors too. But it's important for us to, continue that heritage and legacy of having investors that are patient and that, understand our strategy and understand that, growth that doesn't happen overnight. And so we want patient investors that, fit with our strategy. So that's kind of what the fundraising process looks like. We've got some local Chattanooga families that are invested with us too. They've been with the fund since River 1. So they're really important investors too. So it's a mix of kind of that institutional and then sort of the wealthy individual families.
Yeah. To shift gears, could you tell us a story about a business that you all came across, you decided to invest in, the founder continued to keep equity, with you all, and then you were able to exit and bring the founder even more of a return because of that?
Yeah.
A River success story.
Yeah. So we invested in a business probably in the 2015 timeframe, based in Western Michigan. It was a convertible or a converter of flexible materials, so tapes and adhesives that go in products, and really good business. It was a platform. It had the founder was the CEO, really good CEO. It had a really good CFO. He had built out a good team, a good sales team. So this was an example of a company. We were like, wow, this is a really nice company, really, good platform business that we can invest with and we can grow quick. one of the sort of valuation detractors of that business was the majority of their business was serving automotive OEMs. And automotive OEMs, as customers are generally viewed as, more cyclical businesses, obviously when the economy's soft.
An automotive OEM is...
So like a Ford or a, GM, the folks, the automotive manufacturers, the ones making the vehicles.
Okay. Or the parts for the vehicles.
Or the parts for the vehicles, yep. So the tier 1 and tier 2 suppliers are would be making sub-assemblies for the ultimate automotive OEM. Yeah. Mm-hmm. So, there was a connotation with that business that, it's nice. It's a good platform, but it's mostly automotive. It's mostly cyclical. Like it's going to cycle with the economy and with new car sales, right? And so part of our strategy was let's leverage what they do really well. I mean, serving the automotive market is a tough market. You have to be really, really good with, engineering, and have to have really good product quality, really good on-time delivery. It's a really sophisticated customer to serve. And so let's leverage all their great capabilities and go attack other markets, like the medical market, for instance, which is not very cyclical, right? Really, really recession resilient, really attractive. And so we went out with that company and did 3 add-on acquisitions of converters in the medical space and integrated them, grew them, and took the business in 2.5 years. We more than doubled our earnings, our EBITDA, more than doubled our sales, and took automotive was about 80% of the business when we bought it. And it was less than 50% when, 2.5 years later when we were ready to sell it. Mm-hmm. And the medical piece went from about 5% to 35%. Mm-hmm. So we totally transformed the profile of the business and, the demand drivers of the business, and made it a more diverse business and thus a more valuable business. And so we were able to sell that one in about 2.5 years and sold it ended up being a large strategic. We had lots of different interest from buyers, and the founder, who rolled a lot of equity, made almost as much on a second bite of the apple as he did on his initial transaction, and remains a close friend of the firm today. He sits on another one of our boards today. Really good friends, with our managing partner Mike Brookshire. They go on golf trips together and are involved with the foundation together. So it's just been an awesome relationship over many years.
So you probably know that this is coming. So that's a success story.
Yeah.
Can you identify a deal that you would still do today that's in the graveyard? That's a disappointment and didn't quite go as well.
Yeah. Yeah. So, I've been at River for the last 7 years, and I would say, knock on wood, fortunately in the last 7 years, we have not had, a bad deal, I'll say. Okay. But I've heard sort of the war stories, the horror stories. And
is there one that around the office that everybody talks about?
Yeah, there's a few of them. I mean, I would say they all sort of come back to partnership and honesty and integrity. I mean, sometimes, in these processes, you get to know people pretty well, but, it's sort of like going on 3 or 4 dates and then getting married. So, I think most of the times that deals have turned out not to be good, it's been, probably just not the right partners, not sort of what the founders or the owners of the business told us what the company was. So, I think that's probably the most important thing you can do as an investor is invest with good people, put good management teams in place. The partnership with management is probably the most important thing you can do.
Yeah. We had a conversation in another podcast, I'm not sure if it's come out yet or not, with Joe Maxwell. Joe manages a VC firm here in town, and he made the statement that a bad deal with good people is still a good deal, but a good deal with bad people is always a bad deal.
Yeah.
Which I think speaks exactly what you're saying.
Yeah. Life's too short to work with people that you don't like.
Yeah.
I mean,
or you can't trust
aren't aligned with. It really is. Yeah.
Yeah.
From the business owner, and I'm caught up on this kind of second bite of the apple thing. So just, yes, they may be giving up some of the immediate cash return on the front end, but it's for the possibility of more on the back end through equity, continued equity in the company. Are you familiar? Do you know from an owner standpoint the tax ramifications of continuing to leave equity in a company? Is that post-tax? Is it pre-tax? How does that all work?
I'm not a tax, expert. And so certainly, don't take tax advice from me, but
same,
but generally it depends on your structure. It depends on lots of things, but generally we can usually structure a deal where whatever you're rolling over, reinvesting in the company is rolled over on a tax deferred basis. So, that piece is not, you're not paying taxes on. So that's, there's advantages to that certainly. We can usually structure a transaction that way.
It kind of makes me think, Steve, like a 1031 real estate exchange where you may be selling a property, but you're able to roll all of the proceeds or some of the proceeds over into another property and not pay taxes at that time. It's when you eventually exit and take it out of the space is when you pay the taxes. Same kind of thing, just different.
Yeah. You're only going to pay taxes on the cash that you receive.
Yep.
Versus versus keeping, because that portion of the business you didn't sell because they kept it in.
Exactly right. Yeah. Yep. You retain the equity in the company, and you're only pulling out 80%. And the new tax law, I'm again not a tax expert, but there's a 1202 provision in there that if you're holding the company for 3, 4, 5 years and it qualifies as a small business under that letter, oftentimes you can. You'll be exempt from capital gains tax on that too. So that's another, nice advantage.
We've actually talked about that with a couple other guests, is the qualified small business stock provision. And we found that to be huge. And I know it's industry specific. We talked to Joe Maxwell, a lot of technology companies qualify. Manufacturing qualifies in a lot of instances.
Yep. Ours does not. Professional services doesn't count.
Really? Okay. I didn't know
it doesn't
that.
count.
Wow. Yeah. Most of our deals generally do qualify because they're industrial manufacturing.
Your deals
businesses.
do,
And so for a founder, for a business owner who's thinking, potentially about bringing on a partner or exiting and stepping away, doing the work, 5+ years in advance to help take advantage of that on the first bite of the apple. So I know you have to structure it as a C Corp, and there's a lot of things that go into it. Stuff that people way smarter than me can help handle.
Exactly.
But how? When it comes to tax mitigation, it could be a huge deal.
Yeah, and I totally. I mean, it goes back to the earlier you can prepare for all this stuff, the better, right? The putting in the right team, getting your data cleaned up to go to market, getting your, structuring your business in the most tax efficient way. The earlier, the more proactive you can be, the more prep you can do, the better.
Yeah. I have one last question. I know Steve has a couple to finish on. If you think about a business owner who's listening to this and they say, I haven't done much exit planning, or I'm doing exit planning and I'm thinking of exiting within the next, we'll call it 7 years, some a lot sooner, some maybe later in the game. What is one, I would say, big piece of advice you would give a business owner who's thinking about this?
Yeah. Yeah, it's a great question. I think, again, just probably really doing some soul search and some praying on, what you want out of the transaction. Make sure you know that.
Qualitatively and quantitatively.
Correct. Yeah, good point. Yeah, I was thinking mostly qualitative, but quantitative is really important too. Do you want to continue with the business? Do you want to get out of the business?
Sure.
Like really understand what you want so that you can articulate that to your advisor, to your, next partner. I think being proactive, like going out, making sure you understand how your business is going to be valued and, what you need to do to maximize, that value up front, all the things we've kind of talked about over the last 30 minutes or so. Just doing as much prep work and understanding it, as you can. Because sometimes we'll work with a business and the owner, just didn't realize that his company, wasn't worth 20 times EBITDA, or, didn't actually. We had one recently like, well, I thought I was going to be tax exempt from every dollar that I received. Well, unfortunately, it looks like no. But, just making sure you understand the facts, making sure you know what you want, and then, you're as prepared as you can be to go to market and find your partner, because it goes fast. I mean, these processes, they're fast and, they're a lot. They take a lot of time. They're stressful. And so the more you can prepare and for it, the
you want
better.
your ducks in a row.
Yeah, we've heard about deals that, have fallen apart at the closing table because the business owner's like, wait, I can't come to work on Monday. What am I going to do? Like it's just that's the qualitative aspect of like identity being wrapped up inside a business. And, we talked a lot about setting up your team from the standpoint of making it more valuable to a buyer. But also I think if you create a really good team around you, you're able to reduce how much work you're having to do in the company. And you can explore, what if I work 3 days a week and those other 2 days I'm not in the office? Do I enjoy that? Because, sure, you may be able to may need to stay on for a while, but eventually you're going to step off probably in a board capacity.
Yeah.
And are you okay with that? Steve likes to say, when you're not going into the office, you're not driving 80 miles an hour to work to get there fast, as Joe Maxwell said, what are you going to set the alarm for? Like what's going to be that purpose and passion?
If you're used to driving at 80 miles an hour for 30 years, you're still going to want to drive 80 miles an hour. Yeah. But if it's not at this business, where is it? You need to know where you're headed. Yeah. Because you don't go from driving 80 to going to 40. Yeah. Like it just doesn't happen. Yeah. Because you're wired to go 80.
That's a great point. Yeah.
And so now it might look totally different. Grandkids, sporting events, it could
totally.
Volunteering, traveling, whatever. Yeah. But you got to have that thing or else,
totally. And to your point, you'll regret it. Austin, like if you're able, maybe there's a scenario where you can do a little bit of both. Like you can hire your team and you don't have to be there 5 days a week, and you can be with your grandkids and take up, do your ministry work or coach or volunteer, whatever it is, and still be involved in the business like that. That could be a scenario too. And I would say one other thing that I should have mentioned to your question, Austin, is hire a trusted advisor. There is, transactions are difficult. They're complicated. There's lots involved, from accounting to legal to, just knowing who the right buyers to go out to are. Like if you don't hire a banker, make sure you have a trusted advisor that can explain things to you and that you trust and can help you vet what you're hearing from the group on the other side.
And what we've heard too from professionals is like, if you are in a business that's in a unique industry or you have a specialty in your industry, it's really advisable to find someone when you're looking to do the transaction. You find someone who has a specialty in that, because they know what's ahead. Yep. They can steer you through the headwinds, and they can also help with some of the tailwinds so that you can put wind in your sail. And so, two questions I want to end on. The first question is, we're hoping that we're going to have a lot of investment bankers come and listen, and some business owners too. How can they, if they found this valuable, they'd like to get a hold of you, how can they reach you?
Yeah, reach me by email or cell phone. I could provide my contact information.
Okay, that stuff's on the website too, right?
Yeah. So what's the website?
riverassociates.com.
Okay, good. That's where they can find you. Yeah, all right, great. And the last question is: this is the very last time you're allowed to eat ice cream. What's the flavor? Where are we going?
Wow.
And why is it superior?
And why is it the last one? This is it. This is your last opportunity to eat ice cream. What are we eating?
So my wife's favorite food in the world is ice cream. Okay. She probably has it every night.
Good so woman. You have experience.
Good woman.
I have a lot of experience. I've probably bounced back and forth. I've kind of been on a Jenny's kick lately.
Okay. What's your flavor?
Brown butter almond brittle is probably my favorite at Jenny's, but I think I've got to go with just classic cookies and cream from Bluebell out of the big old bucket.
Oh, out of the bucket
at home. I think that's good.
I think in college I had there was a couple of guys. We played college football, and there was we sat with a couple of offensive linemen, and we all got a tub, and we sat there and ate the whole thing. Like each of us had one. So good.
Individual tub.
Each of us had our own tub. Yeah. Cookies and cream is classic. Yeah.
What would you guys pick? Huh? What would you guys pick?
Well, if I'm going to Jenny's, I'm getting the salted peanut butter fix.
Okay.
I mean, I
don't think I've had that one.
That's my go-to.
Gooey butter cake at Jenny's is my choice.
Yeah. But I think for me, so Midwest Andy's custard, frozen custard.
Okay.
You take me to any frozen custard place, I'll just take a couple scoops of chocolate.
Yeah.
That creamy, chocolatey, it doesn't have to be fancy. Now I can add fancy stuff to it, but
Yeah.
I think that
custard's underrated.
It's so,
I'll give you that,
dude. People, hey, as the kids say, custard slept on.
Slept on. Totally. Yeah. You're right. It's slept on. It's underrated. Yeah. I grew up in Wisconsin, so I'm a custard fan too. Culver's is one of my all-timers.
Yeah. Oh, so good.
It's a good one.
It's good. Conor, thank you.
Yeah. Thank you guys. This has been so fun, and thanks for having me. Really enjoyed it. So thanks a lot.
Cool. Thanks.